Hello, everyone. Let's take a look at range trading in Trade Canary. First, definition. Range trading is looking for well-defined patterns within price action of a stock that has a clearly defined top and bottom of a range where price comes up to the top and then pulls back down to the bottom of that range and then pulls back up to the top of the range. The more times we form that channel within a range, the better of an edge we have for putting on calls at the bottom of the range or puts at the top of the range. So if you go into Trade Canary and conduct this search, by default we're looking at weekly prices. The range is some simple math looking at 14 periods of price, right? So 14 candles. And in this case, weekly. Now you can switch it to daily prices. And then when you're looking at the charts, make sure you switch it to daily price charts, right? But by default, we're looking at weekly prices. And you'll see this little widget here, Range Trader. 5 stars, right? So 5 stars means when we're on calls, it's at the very bottom of the range. And what is that range? Well, it's some simple math, really. We're just looking for those 14 periods. What's the high end of the range and what's the low end of the range? In this case with FBMS, 3506 is the low end of 14 weeks of price history. 3724 is the high end, the top end of that range, for a total value of $2.17 of travel, right, from top to bottom, which represents 6% of the price of FBMS. Today's current price, I should say. Now, what if we see something that's like 80% of the price? Think about what that means. That means the range for 14 periods is 80% of the price. That means it's either going parabolic and breaking out, or it's collapsing and going way down, right? 80% of the price. So what we've defined with this canned package called Range Trader Bullish and Range Trader Bearish on the other side, you can click on Advanced and see what we're talking about here. Range percent of price. So we're looking for anything that's under 10% of the value of the stock, right? We're looking for something that's below the 9-week moving average. That means we're probably at the lower end of the range. That's how we're looking for calls. And then we can go through these results and just click through the charts and see if what we're finding is actually represented in the charts via this kind of obviously defined range that we can trade within. So let's click our first one and look at what we found here. So we'll zoom in. Now remember, it's 14 days of price. So that means 14 candles. And since we're looking at weekly prices, that means 14 weeks. That gives us enough time and price history, which establishes price memory, so that we can trust that we're dealing with an established range. The shorter of a time period we go, you can go to 5-minute range trading, but that means your window on the trade is probably about 10 minutes, right? In the case of a weekly chart, we can go out 2-3 months with calls or puts and play within this range. So, first result here, FBMS. You can see what we're looking for here. We're looking to establish a top range and a bottom range that we can then put a trade on within. I actually really like this one, just kind of out of the blue, because look at what happened here. We have a consolidation period that we broke out of. We then pulled back into that consolidation period, and look at what happened. It bounced. So this gives us some evidence that what we're doing is establishing a new range above this consolidated price history, which establishes price memory, right? So whether you want to look at it as algorithms that are trading this or humans, the memory of price has been established here. And now we're looking to see if we're going to create new range from this breakout. So right off the bat, I love what we found here in these results. It's established like an M. You're going to see a lot of these in range trading, M's and W's, right? So the M is where we want to get in on the calls, right? So we formed our M. We've set up a base here. We've come into the base yet again, and this is where we put calls on to move back to the top of the range. And we want to buy on a down day, a down week, in the stock, right? Because that means we're paying less for time and the calls are cheaper in the case of buying calls. Now, if we're at the top of the range, we want to do the exact opposite. We'd want to put on our puts when we form a wick like this because the puts are going to get real cheap. And look how price memory, price history, when it's established, informs moves, right? So is this going to eventually break out to the upside or the downside into this consolidation period? Maybe. We don't know. But that's the beauty of range trading because it defines our stops and it defines our entry points, right? So here's an entry point where we're playing this range with calls to go to the top of the range, 38.27 from 33. That gives us 5 points, right? And it gives us a top range to put our expiration date out 3 months with a strike price up into that higher 30s range. Or we could buy them almost in the money, right? Too. There's another tactic there. Now you're going to pay more for an in the money call. So if we can get cheap out of the money calls to the top of this range on a down day where we're paying less for price, go out 3 months, we've got a really sweet setup here where we've got cheap calls. We've got a well-defined place to just get out of our trade if we start violating this bottom range or even getting into this consolidation period here. Maybe we just pull the plug and say we don't know what's going to happen. So does that mean I don't care about the company that I'm buying? I still like to buy a company that I feel like is actually a good investment, even if I'm doing range trading. Why? Well, if I'm buying calls, I want calls in a good company, right? Because then I at least have an impetus to say there is a reason for this to obey price history, price memory, and trade within the range. Now, on the put side, maybe we are looking for a bad company. Maybe we've found our little M pattern or our W pattern, and we're going to short it at the top of the range. Well, maybe a bad company gives us a little bit more confidence in our ability to buy those puts, right? So we don't need to overly focus on the company we're buying when we're doing this. Really, this is a technical trade, and we're looking to play within these ranges. Defined bottom end, defined top end. Let's go through a couple more results and see if we can find some that are just immediately non-starters. Like this one. Okay, I do see a range here, right? But look at how volatile it is. And look how we've put in a series of lower lows. So we established a low here. We got a new high, so we made a higher high. But then we made a lower low. And then we pulled up and attempted to come back to the top of what could be a new range, and it failed, into the bottom of a range where we see some wicking that actually created a new lower low. Now, what is interesting here is these wicks pulled back into this little consolidation period. But again, now we're layering on things that don't give us an edge. Unlike FBMS, where we have established range, bottom range, top range, and we have this beautiful shelf below us of this consolidation period. So I don't like COLL as much, not even close to as much as FBMS. Let's go through a couple more. Okay, terrible chart. We don't even need to analyze it. There's no point in getting involved with something like that. Let's go to our next one, HBNC. Okay, this looks like a little bit like FBMS. We've got our consolidation period. We've got our breakout. We've got our shakeout down to a low end of the range. We've got another attempt to move top range that came back into our low range. And it's got this consolidation shelf below us. Price history, price memory has been established here, giving us an edge to say maybe we can get long calls here and pull it back up to the top of the range. So again, this is not rocket science. We're really just looking for a range to play within. Some of the key metrics to look at: what's the dollar range? What's the top and the bottom of that range, right? What percent of price is it? Now, our canned search for this bullish range trade is setting a limit at 10% of the price. That helps us identify stocks where the range is at or lower than 10% of price. So we want a little bit of volatility here, right? If it's 1% of price, that range, it's just a tiny little window that we're playing within. When it's up to 10%, that gives us some possibility for some real alpha. And then we're just looking through these charts clicking through them, we want to immediately see something that looks like a range we can trade within reliably with an edge. This one's terrible. There's no reason to even go any further. Western Copper and Gold. Let's take a look. Okay, now we do have a lot of price history established here. What is the dollar value on this range? So Western. So 10% of price, 10 cents of range. Oh, but look, we're actually only 1 star. We're not bottom of range. So immediately just move on, right? So if it's not 5 star, if the current price is not pegged to the bottom of the range, just don't even bother looking. So here's one that could be good. 5 star, 98-cent range, 8% of price. Let's see what we find. Okay, now this is wonderful. We've got, how far are we going back here? May of 2023, where we really started establishing bottom range. And now it looks like we're going to start attempting to put in a set of higher highs, right? But that doesn't mean we can't put a little scratch pad out on our desk, write this ticker down, and come back to it in a week. See if we're going to pull back into this lower end of the range, and then we can get long calls to the top of it. So we're just doing real quick analysis on these charts, looking for this well-defined, established range. Move on from something that's not 5 star. It means you're not bottom of the range. Move on from something that's more than 10% of price. It means you're dealing with more volatility, which means that the range that's being established is not reliable. That removes our edge, right? We want to find as much edge as possible. That means well-established patterns. So really, again, not rocket science. Click through these charts, do it on Sunday maybe, and put a little scratch pad out of what could be wonderful setups for quick range trades. We're going out a month to 3 months ideally with our calls and our puts, just going to the top and the bottom of ranges. Thanks for listening. If you guys have any questions, please email support@tradecanary.com. Happy to address or elaborate anything you ask. Thanks for watching.